Well, there's been no doubt that 2026 has been a more challenging year for investors. Equity markets are driven by a smaller number of tech companies. Bond markets are facing this headwind of higher inflation. And currency markets are facing uncertainty. Traders torn between the short-term and the long-term implications of this Middle Eastern conflict. In all of these markets, a single headline can suddenly change the investment environment, whether that's from an employment release, some inflation statistics, or simply a social media post from President Trump. So clearly, a tougher environment, particularly for the DIY investor. And I think what complicates things further for currency traders in particular is that the US dollar is not behaving as you might expect. In our most recent Global Investment Outlook, we talked a little bit about how the US dollar is usually regarded as a safe haven currency, and how it's times like these during economic uncertainty and geopolitical stress that the dollar should be performing much better than it is. And yet the dollar has really remained largely stable in this tight 5% range throughout the conflict, despite the fact that the US has a lot going for it. It's got an economy that's performing pretty well, more attractive yields than is available in Europe and Japan. And we have the US being the home to some of the world's most innovative technology companies. Unlike Asia and Europe, the US is also energy independent, so it's less affected by the war than a lot of other global economies. It's a telling sign then that the US dollar carries all of these positives and still can't manage to rally. We think that reflects an underlying bearishness from investors that are willing to step in and sell rallies, and also recognition that the currency is overvalued and carries a lot of long-term negatives that we've been emphasizing in recent quarters. It's not that we're particularly bullish on the euro, the yen, or the British pound, but instead that we see signs of optimism from emerging market currencies. The Renminbi, for instance, is up 6% over the past 12 months, and a number of other emerging market currencies are incredibly resilient in the face of some uncertainty. Currencies of Brazil, Mexico, Hungary, South Africa, for instance, have all offered near double-digit returns over the past years. These are countries with strong fundamentals, improving political trajectories, and attractive yields. They would also benefit from a broadly weaker dollar. So we think this dynamic continues, that these currencies will perform well in the year ahead. And in the same vein, we're also bullish of the more cyclical, growth-oriented, and commodity exporting G10 currencies. That includes the Canadian dollar, which we forecast at 130 per dollar in 12 months' time, and that equates to about a 7 or 8% spot gain over that period.